Let's go back to the S&P within 1% of an all-time high. So if you're an investor, what do you do now? Do you continue to buy equities into a market that's pretty much at highs, or do you look for other alternatives?
Well, obviously, it's a function of your risk tolerance, what your asset allocation is. I wouldn't make any knee-jerk reactions right now. But while on one hand, I think we're going to have a sluggish economy, I think, it bodes well for the economy, for stocks rather. We have to borrow or refinance another about the $3 trillion in debt at much higher rates. The deficit spending is going up. What that does, that creates liquidity. So you have more dollars essentially chasing the same amount of financial assets. It's not just the United States. It's the European Central Bank. It's India. It's China, who's relaxing some of their interest rates. They have fiscal and monetary stimulus. So that's all good for stocks. I would expect stocks to go higher from here. I think there's a certain level of fiscal inevitability to it.
All right, so fiscal inevitability, don't hear that term very often, Ivory. We're going to talk about this a bit later in the show, but one area that's not at all-time highs, that's the small caps. Still in correction territory, I believe about 13% off of their high. Is that one area you would put money to work in if you're saying it depends on your risk tolerance? If you have a pretty solid risk tolerance, bet on the idea of that area rebounding?
No, I think small caps are going to be more interest rate sensitive. I'd lean more towards technology and the NASDAQ. If you look, historically, when global liquidity goes up, NASDAQ tends to outperform relative to the debasement of the currency. So I would lean more towards NASDAQ than I would small cap.
All right, so more to that. What about another sector outside of technology, actually the laggard this year, consumer discretionary? If you look at it year to date, it's down about 6%. And some of the names on here are just deeply impacted by tariffs and also the thought that there's weakening consumer spending. I'm looking at Deckers, Lululemon, Best Buy, deeply impacted by some things that potentially could be resolved. We were just talking about the idea that potentially the tariff pause might end and there might be a resolution. And then also, it seems like at least we're making progress in the discussions with China.
Well, we have a K-shaped economy, and so if you're one of the 7 Americans who visited a food bank last year, you're not in the market for an iPhone. If you're in the top 10%, who, by the way, represent 50% of consumer spending, you're fine. In fact, if you break down the budget, like this $1.3 trillion of our budget is just means tested. That's the Medicaid, the SSI, the food stamps, earned income tax credit. 3.2 trillion is going to be Medicare, Social Security. That's not going to get cut, right? Then you got $2.6 trillion. That's everything else. That's the government contracts. That's the PPP loan forgiveness. Those are the subsidies. That's wealthy people stuff. That's not getting cut. And when they get those tax cuts, and remember, we still have a tax bill on the table, so they're going to get even more of a stimulus. They're not paying off credit card debt. They're not buying a refrigerator. That money's going into stocks. So that's what I mean by the flow of the money. The fiscal inevitability is good for the stock market.
Yeah, also maybe in the Lululemon pants. You never know. One other thing I want to talk to you about is gold. I know you're a big gold guy, so I just want to kind of talk to you about the trends when it comes to gold. So gold's down about 0.5% over the last month, even with all the geopolitical tensions, but it's had a huge run up year to date. And central banks in general, not in the last month, obviously, but over the last couple of years have been a big part of the gold story. We're showing the audience right now Q1 gold buying by central banks. It was actually down 21% year over year, but it's up 25% over the 5-year quarterly average. In your mind, are we seeing a ceiling when it comes to gold? Have we hit resistance when it comes to gold, or is there more upside for gold?
Oh, there's definitely more upside. You got to remember now, in 2009, about 10% of central banks had gold on their balance sheet. That's up to 20%. At the same time, you've seen dollar-denominated assets go from 70% of balance sheets down to about 57% today since 1980. What you're seeing is the dollar dominance. It's not going away. We're not losing the dollar as the reserve currency status. But I think central banks are diversifying for a number of reasons. One of those is that we've weaponized the dollar with all the sanctions. You can ask Iran and Russia about that. So, you're going to see that continue. And also, from a macroeconomic standpoint, when the dollar goes down, that's bullish for gold as well.